Joining us now is Paul Mirren, the co-founder of Msquared Capital. He talks to us about what's going on in the market right now. Paul, good to see you.
Thank you, Peter.
Now, but before we start talking about a piece you wrote for your newsletter around things like the importance of immigration for ultimately economic growth and even house prices and the stability and security of the housing sector, let's just talk about Chris Joy's suggestion that, you know, if the Reserve Bank increases interest rates, we could start seeing house prices fall by 20%. What do you think?
Well, it is definitely very possible. I think it's the analogy is gravity. So interest rates have gone down. Peter Tulips, which is the Reserve Bank's own economist, doing a very detailed analysis in relation to how property prices work. Interest rates is the #1 factor of determining where the property prices are. So when property prices went up, it was as a result of interest rates going down. We've had that 20 to 30% increase. If interest rates go up by 1%, it's natural that it will go down. But it all comes down to even more simple analysis than that. It comes down to affordability. It comes down to simple cash flow. What are people making? What are the taxes and what are they left after taxes, and how much they can afford to pay for the mortgages. So if the mortgages go up, they can afford less. It's a very simple analogy.
Yeah, one of the things I talk to him about, because a lot of people get terrified when they see house prices falling by 20% and they forget how much they've risen by. And they also forget that 20% is an average. Some could fall by more, some could fall by less. And I know you always do your equations based on, well, we're lending to someone who's put their house up as collateral.
Yes.
And you kind of allow for even a potentially 35% fall in the value of that property before you'd start getting a bit worried about the ability of someone to pay you back.
Precisely. Well, normally we only lend 65% against any particular asset. So we're in the worst possible correction that we've had in the last 20, 30 years. It was actually nothing to do with interest rates. It was more to do when the last time the Macroprudential Authority came in 2017 and wanted to slow down the amount of debt that people were borrowing. It just made it harder for people to borrow money. And we've actually only saw a 10% decrease. So it doesn't scare us in relation to where property prices will go. We do think that we're probably at the peak of the market at the moment. But if the Reserve Bank does increase interest rates, I don't think they're going to increase it by 1% all of a sudden overnight. No. It will be done over 2-3 years. People will have a lot of time to anticipate it. By then, we will probably have tax cuts to cushion it. We'll have wage growth as well. So that's the reason why interest rates will go up, is because of inflation. So really, by the time we get to it, I don't think it's going to be as dramatic as what people are saying today.
Yeah, and this is the importance of, I thought, of your newsletter, is that you emphasised the likelihood of two things: that immigration will probably increase, and that will spur economic growth. Why don't you just quickly explain to viewers the relationship between immigration and economic growth here in Australia?
Well, look, when I started writing this particular article, if you look at the context in relation to Australia, Australia is historically the second, sort of the second largest performer in relation to net migration in the world. So Canada is first. I think right before COVID, the 1.8% of the population were new migrants. Australia is 1.6, and it drives. People don't realize in relation to how much it drives economic growth. So for example, if you're increasing your population base by 1%, roughly it's about 2% of your GDP, because you're building, you need to build construction, they're going into the workplace. There is just a large economy that is sustained when you have migration. So with property prices, they don't necessarily go up. Okay, with property prices, it's all about the demand supply. So what you're doing is that if you're actually increasing the demand, what you need to be making from a planning perspective, you need to be approving and delivering sufficient amount of supply. If you deliver enough supply, it doesn't actually increase prices. All you're doing is you're creating the multiplier effect in relation to the economy. So approximately every dollar that's placed into construction, $3 is going into the wider community, wider economy.
Yeah. All right. So and we've seen state premiers put their hand up to really pump up immigration, and I suspect that's going to be an important ingredient in the growth process over the next year or two. You also have a fairly good understanding of the supply of properties in Australia, and that's one of the big problems causing the price rise, isn't it? That we are really bad at supplying properties.
Absolutely. So Peter Tulip, who's actually done another paper for the Reserve Bank, and he's actually attributed that, for example, in houses in Sydney, there's about 70% additional cost on per medium house prices because there's not enough land released, and conversely for apartments as well. So what his paper has actually determined is that a large chunk in relation to the value of property is because there's sufficient supply of it. So in Melbourne, they have a slightly more efficient process. They've got more land, they've got more apartments. The price differential is less, and in Queensland, even lower. So when you actually look at how, on average, how much people are earning versus the value of the property, property is a lot more affordable in Queensland. There's a lot more of it, and they have a better planning process that are able to release more land and more apartments more efficiently. If developers are watching this show right now, they're probably nodding their head and saying, yeah, it's taken me 4 years or 5 years to get this damn approval from council. It is because of that slow process, it actually artificially keeps the prices high.
Yeah. Well, one last thing, and this is something that you didn't cover in your newsletter, I'm sure you're aware of it. Once again, we're starting to see that trek from south to north, you know, that triangle around Gold Coast, Sunshine Coast to Brisbane, I guess across to Ipswich and places like that. Lots of population going into that area. Is that an area that you guys are comfortable to lend against, or are there some areas there that are too volatile for you guys?
Look, traditionally, regional areas is areas that we don't lend to for a number of different reasons. And I think I've come to your show before. In a COVID environment, they've been very popular and performed really, really well. But long term, people want to be close to where there is good schools, infrastructure, and jobs. So that's why metro areas are very good. Given that, Gold Coast is doing very well, and there's a huge demographic internal migration from both Sydney and from Melbourne that are moving into that area, and that creating a micro economy there, which will be sustained. But yeah, there are areas in the regional areas that we love to visit, but from a lending perspective, we see a little bit of risk in relation to volatility and liquidity. So it's just because the price doesn't drop sufficiently enough is a risk element in itself. But if I have to recover an asset, I need to make sure that I can sell it quickly. There's no point of having an asset that hasn't fallen in value, but there's no bidders on the market for me to wait until someone buys it. So that is a very important element for us. The quality of asset is really critical. It's because we want to have in metro areas where we know that the volatility is not very high, and that we can actually dispose of it quickly if we need to. Okay,
one for the road and one for the record. When do you think the Reserve Bank will start raising the cash rate?
Look, if it all comes down to inflation. So if there's two camps to inflation story. There's one camp of the inflation story that believes that inflation will be a transitionary or temporary because of the lockdowns that we've experienced. And there's another camp saying that it's a permanent item. Look, I think that interest rates will start creeping up probably next year, probably later half of next year by maybe a quarter. And I think there'll be a big space between each rate increase just for us to see whether it is truly a transitionary or is it permanent in our environment. But yeah, look, we're always looking at risks, and we're always making sure that we look after our investors to make sure we assess the risk and the type of deals that we do. So that's why all of these elements are so important to us.
Paul, thanks for joining us.
Thank you. Thank you, Peter.